Analysis: loosening monetary conditions threaten crucial financial institution inflation combat. The U.S. Federal Reserve is hiking interest costs on the maximum competitive tempo in a technology, but the financial conditions it desires to tighten to tame hovering inflation are heading in the incorrect route. A rally in equities and falling authorities' bond yields because the Fed's June hike means monetary conditions are actually loosening, no matter the U.S. financial system having been hit with a blended 150 foundation points of charge hikes at that meeting and the subsequent one. Financial situations mirror the availability of investment in an economic system. They dictate spending, saving and investment plans of companies and families, so imperative banks want them to tighten to assist manipulate inflation, which is now running some distance above their target ranges. A widely accompanied U.S. Monetary Situations Index (FCI) compiled by means of Goldman Sachs NYSE, GS, which elements in borrowing charges, equity tiers and alternate prices, has loosened a few 80 basis factors (BPS) for the reason that Fed's June meeting. A similar index from the Chicago Federal Reserve, which tracks financial conditions unbiased of winning financial situations, has grew to become negative, implying conditions are loose relative to what the current monetary picture would usually advise. In the euro area, conditions have additionally loosened via approximately 40 foundation points, consistent with Goldman Sachs, and cash markets have priced out most of the 2023 price hikes they had previously expected. Back in June we thought that U.S. monetary situations were widely in which they should be to engineer the slowdown that you want to convey hobby, salary increase and fee inflation again to target, mentioned Don Struven, senior international economist at Goldman Sachs. Our high-quality bet is that they've eased a touch an excessive amount of graphic. U.S. monetary situations loosen. The exchange in conditions has been driven through recession fears, which have precipitated markets to now not solely lessen how some distance they anticipate the Fed to hike, however also to fee in rate cuts next 12 months. This indicates investors assume the Fed might be more involved by means of a slowing economy as opposed to inflation next year. Fed Chairman Jerome Powell's remarks following the bank's July rate hike were also interpreted via some traders as implying a dovish pivot. Money markets now count on Fed hikes to stop at around 3.6% next March, compared with the 4% anticipated earlier than the June hike, observed by way of a few 50 bits per second of cuts via the quid of 2023. Since the June hike, the S&P 500 has gained 13%, oil costs are down 22% and 10-year U.S. Treasury yields have fallen 70 bits per second. Credit markets have also rallied. To be sure, financial conditions are still some 200 bps tighter than overdue 2021's record low, and shares stay 10% down for 2022. Goldman estimates a 100 bps tightening in its FCI will crimp economic growth through 1 percentage factor inside the coming 12 months. But the recent loosening is coming near what the bank phrases an FCI loop, Struven said. If you spot very extensive extra economic conditions easing that might likely now not be sustainable because the outlook for hobby, wage increase and inflation might look too warm. Unfinished job. That threat is already contemplated in market gauges of long-term inflation expectations. The 10-year U.S. break-even charge has risen some 15 bits per second to 2.44% considering the fact that early July Euro quarter expectancies have risen too. That dovish interpretation was the reason why inflation expectancies have been pushed up once more. This simply is going to expose that the Fed nevertheless has an unfinished process ahead of itself, mentioned Patrick Sainer, head of macro approach at Swiss Re OTC, SSREY. Data final week displaying U.S. inflation unchanged in July rather than growing fueled a further loosening in financial situations. But recent U.S. jobs and wage growth statistics point to an increasing number of tight labor markets. Economists notice the U.S. unemployment price, at 3.5%, is far lower than the lowest level 4% in keeping with the Congressional Budget Office it is able to attain without boosting inflation. Annual salary growth of 5.2% is manner above the 3.5% Goldman estimates is vital to tug inflation right down to the Fed's target of 2%. Pushing back, several Fed policymakers have driven lower back towards the shift in marketplace pricing, emphasizing willpower to hold tightening policy until rate pressures abate. They also say that it is unlikely that the Fed will pivot to reducing charges in 2023.